My name is Jesse Worcester, co-founder and partner of Worcester Investments. And first of all, the title of this podcast, the title of the book that we're in the process of writing is The 7 Keys to Passive Investing in Multifamily Real Estate. And it's definitely a bit of a mouthful, but that's very, very intentional because so the opposite of having kind of this investing 101, this generic, anyone, could kind of read it or anyone should be interested in it type of thing. This is incredibly, incredibly niche, incredibly narrow focus. So having the word passive in there is a big differentiator. Passive investing versus active investing, we can get into that, as much as we'd like, but that's a very, very clear differentiator. And there's not a lot out there that I've seen that really focuses on the passive side. And then even more specific is passive investing. There's lots of different kinds of real estate, but it's specifically passive investing in multifamily real estate. I was at a real estate investment conference, and I'm sitting at a circular lunch table. We're out on the lawn. It was just a break between sessions. And there, at this conference, there were sponsors and a bunch of investors. And this gentleman, just a really awesome guy, we were just kind of chatting away, talking about the conference, reflecting on, what we liked about it, maybe things he was alluding to, and he mentioned kind of some things that he would like to see a little bit differently. So what he specifically said was, and the format of the conference is important. So the format was, I wouldn't say it's a pitch fest, but it was very pitch focused. I mean, that was the structure for efficiency, which is a bunch of investors are sitting in the audience, and then group after group after group goes up on stage, and they kind of have their 15, 20 minutes. And naturally, if you only have 15 or 20 minutes, you're kind of going to spit through like, who are we, and basically why should you invest with us? So very pitch focused. And the comment that this guy made is he said, love this, we love coming here. This is a really high value, but what would really make it stand out, what would really be the most beneficial is if we got to see both sides of the coin. If we not only got to hear from these sponsors, but if we also had our peers from the audience, successful people who have been investing with these groups, come up on stage and share their experiences and share their lessons. Hey, this is kind of how I vet these groups. Even so specific as like, these are the groups that I've invested with and this is how well it's gone, or these are the ones that personally I would steer clear of. But really just the summary of what he was getting at was, we're only seeing one side of the coin. We're seeing a presentation, and with what he was getting at with the investors was, man, it'd be really great to have more of a dialogue with our peers and be able to have someone sharing, maybe ask them some questions. And so that has stuck with me ever since and it was actually an offhand comment. So we were talking about something else and he just kind of went on a little rabbit trail, but that just stuck with me for years. And so I, since then, have been looking out there. I've been looking at, what books are out there, what podcasts are out there, and there's nothing that I've been able to find that accomplishes what he was describing. And so that is what the 7 keys to passive investing in multifamily real estate, that was what it was born out of, was that specific investor who mentioned that specific need, and then this slow building over the years of seeing a need there, and then since that investor made that comment, seeing, my goodness, there's really actually not anything out there that accomplishes this. When I think about who this is for, the first thing that comes to mind is there is a spectrum of sophistication in investing in general. And the goal is that this is such a narrow niche of investing, passively in multifamily real estate, that no matter where you are on the spectrum of sophistication, as long as that is an interest of yours or it's something that you're already doing, that this is a hugely valuable resource. So that's really who it's for, is anyone who's has any degree of interest in passive investing in multifamily real estate, all the way up to the most sophisticated, someone who's been doing it for 40 plus years. I think there's definitely something for anyone along that continuum. What does someone get out of it? My hope is that it would be an equipping. It would be this tool and a resource that someone finds themselves just continually coming back to. Because you never really know what answer you need until you have the question. So it might be someone is going out there and they're starting to vet sponsors, and they read the book or they are listening to the podcast. But 6 months later, it's like, okay, now we've gotten into, and now I'm like really vetting a bunch of deals with a couple sponsors. Now I kind of go back and re-consume the portions that are most relevant to me. So that is the goal, is that it's kind of the definitive resource for folks who already invest in passively in multifamily, or who have any sort of interest in it. Risk-adjusted return. Risk-adjusted, once you add that qualifier in there, it becomes an opinion, because two different people are going to view the risk of an investment a little differently. Like if I were to say to someone, how risky is keeping your money in your bank account? Someone might say, oh, that's incredibly safe. That's the safest thing I can do. There are plenty of people who, they look at the time value of money, they look at inflation, and they say it's incredibly risky to keep my money in my bank account. So that's just like one example where risk is relative. But I believe when you peel back the layers, when you look under the hood, when you really start digging into what are all the investment options out there, multifamily real estate simply just starts to illuminate brighter and brighter, and it becomes kind of this like obvious, oh my gosh, for what I'm risking, for what the downside is, the returns are just really, really strong. So the overarching, what does someone get out of this and what is this all for, is the exciting thing to me is we are simply sharing good news with people. We're sharing something that we've seen it with our own investors. I've seen it with any investor that I meet in this space, whether they've invested with us or not. Their expectation and the returns they get and what they're doing for themselves and their family is very different and substantially better from an investing standpoint than I think what you see elsewhere. The keys are like a funnel, okay? So the first key is the broadest. It's like if you have any sponsor or any investment that you're looking at, you can kind of drop it into the funnel and evaluate that sponsor or that opportunity by just kind of going through the layers, and the funnel gets narrower and narrower as you get to the bottom. So one of the purposes is that this is a reference that someone can go back to time and time again, and they can say, hey, I'm looking at this opportunity, or I'm looking at this sponsor, and it's a reference check. I'm going back and I'm referencing the 7 keys. And it's also meant to be chronological prioritized, meaning start with the first key, and I'll walk through the keys here in a second. Start with the first key, and you don't go to the next layer. If it can't pass the bar at that level, it's probably not worth your time to go to the next level. So the 7 keys are, the first 4 are about vetting the sponsor and their trust, track record, team, and transparency. And then the last 3 are type, thesis, and terms. Okay, so we'll kind of break down each one of those one at a time. Trust is the only one out of the entire 7 keys that isn't really an individual checkbox, so to speak. What it is it's this core foundation that you're first assessing it initially, and then throughout the process, as you go through each of the additional 7 keys, you're kind of referencing back. It's that gauge, it's that barometer where there's kind of this initial, you're going to have an initial introduction, you're going to have some initial materials that you're reviewing, you're going to have some initial questions that you have, and it's that there's kind of an initial gut check. Do I see any red flags? Does this person seem like they're just, promising the world, overinflating things? And so there's that initial gut check, and then as you work through each of the additional keys, like the next one, for example, is track record. So you have that initial discussion, you say, this person seems fairly trustworthy, or, no red flags, that type of thing. Now you go into evaluating the person's track record. That's another gut check where if stuff they said to you in your introduction with them turns out to be a little off, or something they said, one of the claims they made was actually false, it's like, boom, you're kind of going back to that, trust element. And if that's not there, anyone you talk to, any sophisticated investor in the space that you talk with, it is kind of this obsession with trust. Without trust, it's like you don't even start down that path. Track record is the next key, and the process of evaluating track record that you hear a lot of people talk about is the first thing that you're looking for is, do they even have the data to share with you? Then you're looking at historical performance, historical returns. A really, really critical, arguably the most critical thing, and this is again a personal preference. This is definitely our personal preference as we've gotten into passive investing with other groups. This is probably one of the number one things that we look at is, does the sponsor underpromise and overdeliver? Where are their projected? This is a really critical distinction to look at on if they have a property portfolio that shows their historical deals. Does it show what they projected on a deal-by-deal basis, what they projected it to perform? And is there, what is the difference between where they're projecting and where it's actually performing? It's just a really, really valuable thing, and something that we prioritize a lot, both in the way we present opportunities to investors, but also as we evaluate other investors, is, are they presenting a picture, a hypothetical picture of how we think this investment is going to go, that it turns out over the years, as you look back on it, it's like, that was a pretty conservative projection. Were they giving me the best case scenario, or were they giving me a fairly conservative scenario where internally they're thinking, hey, there's a lot of ways we can improve upon this return, versus, hey, this is the scenario if like everything goes right. So that's a really, really important distinction and an important thing to be assessing when looking at someone's track record. And so a really, really important thing to evaluate is, what are the types of deals that a sponsor is going after, or the types of deals that they have available at the present time, and how do those compare to the strategy of their track record? Just to give a simplistic example is, if a company's track record is buying D assets 50 plus years old in really troubled markets and renovating them and doing well at that, and then today they're building brand new construction, ground up construction, A+ product, that's a wide chasm to jump across, and to know all of the differences between those two strategies. So that's just an important thing I wanted to make sure to mention on track record, is not only are you assessing their track record, but you're also assessing how their track record compares to their current strategy and the current deals that they're bringing you. Who are the actual decision makers? Ideally, and this is very common, you're going to be wanting to talk to the principals. Like who are the people who actually give the final stamp of approval? And on that level, you're really wanting to talk and get an understanding of investment philosophy. What are how do you evaluate risk? How do you evaluate deals? What type of returns are you targeting? How do you think about how long you hold properties? Just really talking about philosophy in general. But then as you meet with more and more of the team, you typically are going to have some folks who are leading the charge on the acquisitions, who are kind of boots on the ground, looking at properties, walking properties, ideally out there trying to find the greatest deals that they can. Then you have folks on the asset management and property management side, absolutely critical, essential to the underwriting process. So you can go out and buy a property and put all these projections together, but what is the opinion, what is the perspective of the people who are actually going to be taking over that asset and actually managing it? I think an important element to consider is, this is definitely something, a pretty clear distinction between groups is a group managing the properties themselves? Are they bringing in a third-party manager? If they are third-party management, if that is their structure, that's kind of opens up a whole new set of layers to evaluate, in my opinion. And so that's a critical distinction. Are they self-managing? If something is going wrong on the property, is there a finger being pointed to a third-party manager, or is it, hey, no, this is our team. It's on us. We will go out and fix it. And so that's an important distinction when it comes to team. So transparency comes down to communication. It's some things to evaluate are, what does the monthly or quarterly reporting look like? Is it just a really basic couple reports that are spit out, a couple financials? Is there a narrative? Are there phone calls? How accessible are the principals? How accessible are the people on the team? This is a common thing that you end up seeing is it's not uncommon that the most valuable person for an investor to connect with is not a principal on an item. You want to talk to the director of asset management. You want to talk to someone on acquisitions. You want to talk to someone in accounting. And so how accessible is their team? How accessible are they in general? Another element on transparency is, I'll kind of rattle through the things to be checking out. Do they have any sort of an online portal where you can log in and see things like data on your investment, P&Ls, ideally reporting on your return? There's a number of softwares out there that are available to sponsors, so that's something that usually if a group is of size, they'll have something like that. So access to an online portal is one thing. What is their process of when investors have questions or issues? Who are they reaching out to? Is that something that's kind of an established process, or is it hit or miss on who you reach out to and who you talk to? And the easiest way to evaluate a group from the standpoint of transparency is just, what is the information they're able to provide you on the front end as you're vetting them? When it comes to evaluating transparency, an important thing to think about is, what data is available at my fingertips? How is the sponsor stewarding my investment and the asset that we're invested in? And there's an element of knowing what data is available at my fingertips if I so choose. So oftentimes, I mention this oftentimes, if an investment is going really well, there's going to be less questions. But the important thing is, regardless of how it's going, at any time, I'm traveling on a trip, I'm halfway around the world, or I'm really busy with family and friends or engagements, or I have time on my hands, regardless of what is going on in my life, what information is available at my fingertips to where when I want to get a pulse on the latest, what's going on, is it all available for me? So one example is a lot of groups will have, this is something that we've been rolling out, is a portal where someone can log into and they can see kind of the historical quarterly or monthly reports. They can, if there were any webinars or calls regarding the property, that those are on there. So kind of ideal is to have kind of a one-stop shop where when I want to access information, I have a place I can go where I can do that, where I can access it and get my questions answered. We're now into vetting an investment, an individual property, an individual deal. And the first layer of evaluation is the type. What type of property is this? What type of deal is it? And it's a pretty basic layer, meaning it's pretty easy. It's a checkbox, it's an evaluation, but it speaks to something, I would say, a lot deeper, and which is worth looking under the hood and evaluating and thinking about. So this is part evaluating the deal, and it's part internal reflection, kind of matching or gauging what the investment is against your own investing principles, your own investing values, really your own degree of risk tolerance, and really what you're looking for in investment. So the type of the deal, I'm just going to kind of meander through the different types and comment on them and some things to be cognizant of on these investment types. There's a lot of graphs and there's a lot of materials out there that paint a pretty picture of this, and some consider it a continuum where you go from the kind of lowest risk, most conservative investments along the spectrum, and there's debate on exactly which type of investments fall where, all the way to kind of the highest risk, highest reward type of investments, the most aggressive. So you start at one end of the spectrum, which is considered kind of your core plus, which is, in simplistic terms, it's your nice, new, brand new type of product in a really, really good area that everyone would agree this thing isn't going anywhere. This is a great piece of property. It's in an ideal location. It's in a great sub-market, and it's a really beautiful product. It's a really beautiful investment. A lot of investors like to own that. There's a sense of pride of ownership that you have something that's really nice. Hence, because of all those reasons, the returns are just typically expected to be a lot lower on those types of investments. So as we're looking at these, as we're talking about type, there's this evaluation to do on where is my comfort level and what are the types of deals that I'm targeting. Additional types of deals, something that is a really common term that a lot of people talk about is value add, the value add strategy. That's something where we've seen a lot of our best deals are in this value add strategy. So I want to talk about value add because it falls into the type of deal very significantly, and it's something where it's worthwhile peeling it back a little bit and saying what exactly is value add, what are the different types of value add, what are the different degrees of value add, because this is very commonly, I see a lot of offerings out there where they almost all say value add in some way, shape, or form. So there's an aspect where we want to be able to evaluate what exactly do they mean by that and how significant is the value add and how much of a challenge is that value add going to be. It's another thing that goes back to key number 2, which is track record and strategy. Is their value add strategy and what they're doing with that property, is that in line with past investments where they've had success doing something like that? So value add, I see it as again, kind of a continuum where you have the most aggressive type of value add all the way down to you have some pretty simple value adds. So one value add is management. You're buying a property where the management is subpar for whatever reason. It might be a mom and pop operator, but for whatever reason, they are simply just making poor decisions at $100, $200, $300 more than they're at, and they're just choosing not to. They've just been lazy, or they, for whatever reason, are just renting their units too low. There could be elements of lack of professionalism, lack of marketing. Anything to do in the management category is the easiest value add to fix, because you simply go in, you put professional property management in place, you start making good decisions, you start running it like a well-oiled machine, and those results are typically the quickest and the easiest to see is management change value add. So that's one category, and we love to see some of the most exciting deals that we find are ones where there's not a whole lot of problems at the property. We like the physical asset, we like everything about it, but we just feel like the management there is pretty subpar. So that's one category. Another category that you have is, and this is kind of a spectrum here, is physical rehab and reputation rehab. So and those are the ones that can take longer and kind of takes longer to see the ROI on those. But a critical distinction we'll talk about is the physical rehab. So what are the things that are planned to go in and fix? What is the expected ROI on fixing those items? I'll use an extreme example where this would be a red flag to me. If someone says we're going in and we are repainting the exterior, we're repaving the parking lot, we're not doing anything to the units, and we're going to bump the rents, a huge amount. My first question would be, you're not doing anything to the bathrooms, anything to the kitchens, anything to the things that typically are going to drive your rental revenue up. Because ultimately, there's a first impression, someone drives through, there's a first impression that they see on the property, but making improvements to the units is most often where you're going to see your biggest bump in rents. So trying to see what are the physical renovations that they're doing, and do those align with the increase in rents that they're projecting. There should be kind of a common sense gut check element of, okay, they're fixing or they're improving these things. I personally can see why that would drive the rent. I would pay more for a place if I was a customer. I would pay more for a place if those things were addressed. Now, the last area of value add is, and it's the hardest to overcome, and so this should be considered when evaluating an opportunity, is reputation, and you could almost say area as being a part of. You can't fix the area, but if you're in a rough area, that goes along with your reputation. You can have a good reputation in the not so great area. So I'm kind of combining those two. But reputation is the biggest one to overcome, where you have to change management. 9 times out of 10, you're having to do some physical repairs, plus you have to get the reputation of the place in the community improved. And that can take a while, but those are kind of the 3 elements of value add. And it's important to be determining kind of where in that spectrum is the business plan, how aggressive is the value add, and how logical is it that value add is going to be achieved. Kind of a final piece when it comes to value add is just the timeline that the sponsor is projecting to achieve the value add. It's great. We've gone in and we've boosted rents, and we've made a bunch of changes in the first couple months even, and just had this really incredible value add right out of the gates. We don't underwrite it that way, and it's a red flag to us if someone says, hey, we're going to accomplish all of this in the first 6 months. We typically have our value add schedule completing over 3 years giving ourselves plenty of time to encounter unforeseen issues and to be able to overcome those. Definitely on the most aggressive end of the spectrum when it comes to the type of investment that you're evaluating. Anything to do with new construction, with development, with a historic redevelopment, anything in that area is going to be the most aggressive. It's typically going to be where there's no cash flow, there's no distributions for months or even years, because, for example, a typical construction timeline is 18 months, something like that. So you might be buying the ground, and then there might be a holding period, and then you start construction. So, I mean, we've had this deal that we purchased, 184 units. We're here in the heart of downtown Kansas City. I mean, we bought this building, held it for a couple of years, then we did a historic redevelopment. I mean, this was 4+ years before any sort of distributions were seen. And so that is an end of the spectrum where it's really important to evaluate, is this type of investment something where I'm willing to wait this long of a period, and there's a lot more risk in that because you have a lease up period. There's a lot that has to go right. And so when evaluating a sponsor who's doing a project in this category, really what you want to see is having a comfort level of, are they the right sponsor to do a project like this? Is this something that they've done in the past, that they have experience in, that they've seen success in? And when we've done investments all along the spectrum, and our niche, our very narrow business model that makes us unique is that we all of our projects are just in Kansas City. Everything that we've done is within a 1-hour radius of Kansas City, outside of one deal that we just did, which is in Wichita, which is 3 hours away. And so our narrow focus is, even though we've now gotten into development, it's that we see a lot of development sites all around Kansas City, and we've chosen a small select few where we've said, this is a no-brainer. We're getting a great deal on the land. We're getting a great deal on this opportunity. And even though if you were to go back 5 years at that time and say, well, we don't have experience developing, there's an element where it's like, yeah, but we have a lot of experience, probably as much or more than anyone else, when it comes to acquiring and managing multifamily in the greater Kansas City area. And so a lot of the emphasis for us getting into the development side was just our expertise in the industry in general. And we had a learning curve on the development side and on the construction side, but our approach of how we purchased the deal was kind of a barrier, was a buffer for us to be able to maybe make some mistakes and not do things perfectly on the development side, but to make up for that we just, at the end of the day, found a great deal. So when it comes to type, in summary, the simplistic way to look at type is, this is a fairly basic analysis. I mean, the individual investment is going to fit into one of these buckets. And the important thing is that internal analysis of just, what is the type of return that I'm targeting? What is the type of risk tolerance that I have? And even though you have deals that fit into a certain bucket, it's really important to kind of peel back and look at a couple layers below when it comes to the type. So, for example, with value add, I would almost fit in the word business plan when it comes to type. That's a really important qualifier, is not only are we looking at the type, but it's the type plus the business plan. Okay, this is a 30-year-old property. It's got, some nominal repairs that need to be done to it. What is the, okay, so that fits into a category, but just as important is what is the associated business plan for that type. And so that's just a really, really important distinction is to be evaluating the types of deals that are in your comfort zone, and also how aggressive, that's an important thing, how aggressive is the business plan. And both of those just speak to risk tolerance and expected upside or expected return on the deal. The more aggressive the type of asset and the more aggressive the business plan, the more that has to be done to fix it. Typically, you're going to expect higher returns. And if you find an opportunity where it's an aggressive business plan, it's an aggressive type, but the sponsor has a lot of expertise solving those problems on the property, I think that's an opportunity to really consider. The thesis and the narrative is all of the surface level. It's everything you can get from an opportunity in the 30-second explanation of it, everything you can get on kind of the opening, the summary, if you were to watch a webinar, if someone was presenting on the opportunity. It's the high level, does this deal make sense? Because everything about how the deal was discovered, how the sponsor is a good fit to be buying this, managing it, the business plan and it's very much a gut level, a gut check kind of analysis. But it's so important to separate it out and distinguish it, because deals that don't make sense, when you just tell it to your neighbor or tell it to your friend or say it back to yourself, if something doesn't make sense, that's a really big red flag. This is common throughout investments in all categories in the investing world, is why, a couple questions that should have a really good answer. Why are we getting a good deal? Just what about this opportunity? Why would that seller be selling at such a discount? If the story is the seller on this deal is a large corporation, they're flush with cash, they're doing great, they're not motivated, they marketed this thing and there was a call for offers and a bunch of people were bidding on it, and we got the deal, I'd say, what? That just doesn't add up. It sounds like they're getting top dollar for this deal. Now, if that same story was the case, and I heard that, and they said, but we have been looking at this opportunity for over 3 years, and it's a really complex deal, and very few people understand the inner workings of it. Maybe it's a tax credit deal or it's a historic deal, and we actually know a bunch of information about the history of this property or its potential of where it can go that other people don't know. It's like, okay, now there's an element to that where I can see that would make sense that someone would be getting a good deal. So it's just a very critical layer, is to assess, first of all, is what's the story behind the seller? What's the story of how you found out about the deal? What's the story of how it got negotiated? How did you come to that final price? A lot of that is a really, really important layer. And then the same thing goes to the high-level business plan. This goes back to key number 5, which is the strategy is a really important. The business plan is a really important element of the deal. So the reason why I say thesis is you've got some sort of statement, you've got some sort of hey, we want to buy this and it's a good deal, and the thesis is the defending of that claim. And the kind of important element that I would say when it comes to evaluating key number 6 is, can someone answer the questions, the high-level questions that I have, and can they sell me on the deal in a conversation? It's the narrative element. Does the story all make sense? Does the business plan all make sense? Why are we buying this? What are we going to do with it? Where do we feel the value is going to be? Does all of that make sense? And is all of that, something that passes the gut check of this sounds like a situation where there's going to be a really great opportunity? We have, I would say, because we are so narrowly focused, specifically in Kansas City, that most of the deals that we're buying, there's kind of a long history to, we've been looking at this deal for a number of years. We've known about it for a number of years. So-and-so, sold it for this amount, 4 years ago, and we're getting it at this, whatever it is. That's something that is really important to us, and that's a reason why we've kept our focus so narrow. So one example is Oak Tree Square. I was in my car, or we were working late at the office, and we got a phone call from a broker, I think it was, someone in the industry, and we knew it was a deal within 5 sentences. It was simply, what area is it in? What's the price per unit? Right then and there, we were actually working on a separate deal. And as soon as we got the phone call, it was, drop what we're working on. This is a deal. Unequivocally, this is a deal. We had looked at, it's just an interesting story. It was probably 5 years prior, 6 years prior, something like that, or 2 properties side by side. And we had looked at the neighboring property, and it was really, it was kind of like the ugly stepchild and this, really much nicer property. They were side by side. And we had looked at the ugly stepchild property. We had really closely considered, it was really close on the numbers, and it was something we had ended up passing on, or we couldn't get the right pricing on it. But it was $25 a door. It was a good opportunity, good deal. And 5-6 years later, the much better version, much more attractive property, we were able to get at $21 a door. And so that is a story. And when it comes to the kind of the backstory of that, this is a common thing that we see, is a property goes under contract multiple times, and for whatever reason people back out or people are unsure, and the seller their patience gets worn thin. And this one was, I can't even remember the specific circumstance, but there was basically 45, 60 days at the most to close. It was a situation with the seller, and they'd been under contract, and it was like, this is a last minute thing. Someone needs to step in who knows the history of the deal, who has a comfort level to move really fast. We definitely were in that situation. And so, we went under contract almost immediately, and it turned out to be a great deal. And so that's just one example, or one element where the story behind the deal, it's like you can describe it in a couple minutes, and it's like it just makes sense. The numbers make sense. That's a narrative. That's something where you'd be really surprised if that doesn't turn out to be a great deal. So when it comes to terms, there's a lot of detail you can go into. But if you were to summarize it, if you were to try to just look at it from kind of a high level, you're first evaluating, does everything about the details that you're digging into, does it match with everything you've been assessing about the deal, the property, and the sponsor? So does it kind of pass muster? Do the numbers and does the underwriting match the narrative and the thesis that's already been shared? Does it match the business plan that's already been shared? So that's one where that's kind of the check the box, how accurate, how much does it line up? The second component is absolutely people are going to go right to, what is my forecasted return? What is my projected return? And kind of the summary of that is just to separate out what is based on assumptions and what is based on what is in the sponsor's control. That's a really clear distinction. How much of the improvement or how much of the return that I'm expecting to get comes from things that, hey, if they just execute the business plan, that should happen. And how much comes from there's some speculation that something's going to happen in the marketplace. And the most kind of notable of that is if there's a forecasted sale or a forecasted refinance, what are the terms that are forecasted? How aggressive or how conservatively are those forecasted? And just to take those with a grain of salt on forecasts or speculations, not to put too much emphasis on those and to put a lot more emphasis on what is in the sponsor's control. And then the last piece when it comes to the terms is the structure, and this we can get into kind of the legal or there's a lot of technical here, but is the structure of fees and there's preferred return and there's a post-pref split. Ultimately, at the end of the day, a really important analysis that I see a lot of people talking about is to work backwards from, you start with the forecasted return, and to work backwards into all of the details that create that return. So a great example is this. First and foremost, do not start with fees at all. There's a lot of folks who that's not the first place they're going to start, is how are the fees structured. At the end of the day, there are absolutely groups who can have higher fees, but if they're great at what they do, even with higher fees, they can produce much greater returns for their investors. And so an important thing when it comes to fees, this is just keeping it high level, an important thing to assess is how aligned is the sponsor with the investors. This is really absolutely a layer in and of itself, is are the fees structured to hopefully just cover costs, just break even? Is the sponsor profiting? Are they building their own wealth based on fees, or are they building their wealth because the business plan goes according to plan and it's actually a successful investment? The number one thing, in my opinion, to assess, and there's can be endless debates on which fees are most appropriate and which structures are most appropriate, but the thing to just keep returning back to is, are we in alignment? To give a couple examples, you've got very common fees that you're going to see is you've oftentimes got some sort of an acquisition fee. You've oftentimes got unequivocally, you have a property management fee, whether the sponsor is managing or whether it's a third-party manager. That's just a given that there's going to be a management fee. You might have some sort of refinance or disposition fee, but the question on every fee should be, how much is it? And just roughly speaking, how much of that is profit margin for you? For us, you look historically, and our fees have always been designed for us to either break even, or oftentimes many years we lose a little bit of money when it comes to our fees. A great example on the acquisition fee is we have an acquisitions team, and they are out all day long. It's their full-time job is to find deals. We charge an acquisition fee to simply cover their cost. And if you look back historically, I think probably 80-90% of the years we've lost money or broken even, right in that range on covering the cost of that team. So the benefit to us, and something to look for, is the benefit to the sponsor is, are they making their money because they actually went out and found a really great deal? They actually managed it really well. They were hopefully, and the thing to look for is, are they in alignment with the investors? So fees, it's a great thing to dig into. Fees are a great thing to dig into and understand, but you can get lost in the details, and the important thing to assess is just the alignment with the investors and the sponsor. Another piece to think about on return is to keep going back to the sponsor's track record of where they forecast versus where they end up hitting. It's just such an important thing to not get caught up on a shiny, best case scenario forecasted. There's a lot of folks that I talk to who are like, if I see a return that's too high, I don't even look at it because something's got to be off there. That's a personal preference, or that's something that I've heard a lot of people say. But the important thing to really assess, the most important thing to assess, in my opinion, when it comes to return, is not only where is the forecasted return at, but asking the sponsor, point blank, how likely do you think it is, or what are the avenues where this return performs better than what you forecasted? And if you start to dig in and you start to realize this sounds like one of the most conservative scenarios that the sponsor thinks is going to occur, that really, they don't see many scenarios where the property's going to perform, worse, and where the deal's going to be worse than what they projected, and they actually just see a lot of pathways to where it's going to perform better. That is a much more critical analysis than the what is posted, what is the advertised return. Because, if you're comparing someone forecasts a 12% cash on cash and someone forecasts a 10%, but you dig into the history and the person forecasting 12% has, continually misses their forecast. The person forecasting 10%, almost like clockwork, is really crushing their forecast. It's like, at first glance, you might really gravitate to that 12% return versus the 10% or 9% or 8%. But upon deeper, discovery, and upon, deeper analysis, you find out the likelihood of my return being, the greater between these two deals is actually with this, more conservative projection and more conservative sponsor.